Consumer sentiment in the U.S. is sliding to near historic lows as Americans grow increasingly frustrated with the economy. But don't tell that to stock traders. The S&P 500 has hit 4 record highs this month. So why is Wall Street so upbeat when many Americans feel like the economy is lousy? Let's get some answers and break down the numbers with CNN senior reporter Matt Egan and CNN chief data analyst Harry Enten. All right, Matt, to you first. What's going on here?
Yeah, Brianna, look, the mood on Wall Street has been unbelievably positive and optimistic. The stock market has taken off basically like a rocket ship ever since the president paused those Liberation Day tariffs. The S&P 500 has added almost $14 trillion in value just since those April 8th lows. It's been a stunning increase in value in a short amount of time. And the Nasdaq is on track for its 6th consecutive record high today. Now, that's because investors are really fired up about the Federal Reserve. Interest rate cuts, they tend to boost stock prices. They make stocks look more attractive than bonds. They can boost the economy. And so that's what investors are focused on. But the mood on Main Street is anything but euphoric. We learned on Friday that consumer sentiment fell again this month. I like to look at independents because we know there is some partisan divide in those numbers. And, independents at this point of President Trump's first term, they were feeling really good. But consumer sentiment is almost half of where it was at that point. And what's been incredible is that investors have been totally unfazed by signs of trouble in the real economy. Sure, hiring has slowed to almost a halt and unemployment has started to tick up and inflation is at a 7-month high, but investors, they're focused more on better than expected corporate profitability. They are loving the AI boom that has boosted NVIDIA and Oracle and so many other companies. And yes, they're focused on the Federal Reserve. Investors are increasingly confident the Fed is going to cut not just this week, but in a series of cuts in the coming months. Of course, the Fed is not cutting interest rates because inflation has been defeated, right? It hasn't. The Fed is cutting interest rates because they're trying to shore up the job market. And veteran market strategist Art Hogan, he told me that celebrating the Fed coming to the rescue is kind of like celebrating an ambulance arriving to your house early until you think about why you needed an ambulance in the first place. So, Brianna, that's where we are right now. A lot of focus on when the Fed is going to cut and by how much, a lot less focus on why.
All right, Harry, tell us more about what Americans are feeling about the economy and what they believe is important, because it sure isn't what investors think is important.
No, and that talk of ambulance just reminded me a few minutes ago. I got a call. Apparently my LDL is up through the roof, so I might need that ambulance. Anyway, what are we talking about here? U.S. economy is getting worse. This trend line is no bueno. In November of 2024, when Donald Trump was reelected, was 42%. Look at where we are now, up to 56%. The clear majority of Americans believe that the economy is getting worse. Less than a third think that the economy is getting better. This is a very, very troubling trend line. And of course, as Matt was talking about, what are the top concerns for Americans at this particular point? The top issue for you right now, hello, what's number one on your list? It's inflation. It's 34%. The economy, 16%. You add the two of those together, that is a majority, 50% of the American public who say either inflation or the economy is the top issue for them right now. Nowhere on here do I see the stock market, because obviously the stock market's doing pretty gosh darn well at this point.
Well, how many people own stocks?
Yeah, okay, I think this is sort of the big giveaway here, right? This is what we're talking about. If the stock market was the economy, then everyone would be smiles and everyone would be fantastic. But here's, I think, the thing that's so important to note. American families who own stock, any stock, including indirectly, that's 58%. Of course, we're talking ETFs, mutual funds, retirement accounts, et cetera. But directly, the folks who really probably are keeping their eye on the stock market every single day, that's only 21% of American families. So the stock market doesn't equal the economy. Yes, the two of them are oftentimes tied up together. There's certainly some correlation going on here. But when we're talking just a fifth of Americans who own stock directly, no wonder there is this massive, huge wide open gap between what the stock market is doing and those who are involved in the stock market daily and what the American families are doing, because at this point, they're just swimming in totally different directions.
Yeah. Thank you so much, Harry and Matt, for taking us through that. It's illuminating, and we appreciate it.